Thank you so much for coming this morning. I'm going to turn the event over to Chris Crow.
Thank you all for coming. You all don't know, I'm Chris Crow from Congressman Johnson's office. Congressman Johnson and NCRC has been leading the fight to modernize CRA since 2001, so it's been kind of a long fight to do this. I know you all really don't want to hear from me. I'm not the expert on this. So I'm just going to turn it over to David Berenbaum. He is the Executive Vice President of NCRC.
Great, thank you, Chris. Good morning, everyone. My name is David Berenbaum, and I've served for 8.5 years as an officer with the National Community Reinvestment Coalition. And we are at an exciting moment in time in our nation right now. I mean, we are facing some very, very serious challenges, particularly in our financial markets and our real estate markets. And homeowners and consumers around the nation are particularly facing some very troubling trends. 10 million plus foreclosures, unemployment rates coming close to 9% now, community tax bases falling, and particularly in low to moderate income areas and communities that are facing high foreclosure rates, it is very, very troubling. But in the face of these dire statistics, there's a lot to be celebrating. And in particular, if we look at the history and the future of the Community Reinvestment Act, it is one of the few real points of sunshine as far as how the financial markets have been working in this country. We're very appreciative that Eddie Bernice Johnson and Representatives Gutierrez and Barbara Lee have worked with us to coordinate today's briefing. We are filming it so that, in fact, our 600 member organizations around the nation will benefit from the discussion today and be able to use the briefing as a tool as they work locally with each of their members of Congress to see this important legislation expanded during this session. The National Community Reinvestment Coalition for years, in fact since 1990, has been fighting for access to quality credit for hardworking American families. Our goal, our vision is quite simple: to see a financially inclusive society where we see strong and robust business working, where we see Americans having access to quality banking services, where in fact every community benefits from strong investment from products and services that are responsibly originated using safety and soundness. And in fact, if you're not familiar with the Community Reinvestment Act, that is a requirement under the law. Frankly, CRA Modernization will encourage all businesses, whether they be investment banks, securities firms, large national banks, small local banks, large credit unions, insurance companies and others, to lend in a colorblind way and in fact to lend in a quality way. It will prompt investment in our communities at an unforeseen level. Look at what in fact has been going on today. If you look at who is responsible for the crisis we're in and who is not, it is quite clear that CRA regulated institutions are not responsible. There's been a lot of smoke and mirrors out there about that. Who is responsible? And some have been incorrectly, pointing to CRA as being one of the culprits. In fact, only 6% of the high-cost loans that are suspect right now were originated by CRA regulated institutions. Overwhelmingly, they were originated by institutions who did not have adequate regulatory guidance. So we believe that CRA will in fact promote an environment where responsible lending is occurring from Main Street to Wall Street and will ensure fair lending and equal access to lending. It's simply win-win for America's communities and America's consumers. Now, joining me here today, we have a number of experts who frankly have worked with CRA on multiple levels in a small business environment, in the mortgage environment, in the investment community, all to ensure sustainable and in fact healthy communities. And as we move forward in the discussion with regulatory reform, it's our hope that all of the members of the Congress, whether they be liberals, blue dogs, moderate Republicans, whoever they may be, will see in fact the strength of H.R. 1479 And we hope that, frankly, by this summer, we'll be on the floor of the House of Representatives. I'd like to turn it over now to my colleague, Josh Silver, who is an expert on the Community Reinvestment Act. It appears we still may be having some problems with our PowerPoint presentation, but Josh will be clear and concise on the issue. And you have, to the benefit of today's presentation, the CRA toolbox, which has been shared, it's been distributed to all the House offices, and I think you'll find it a great resource during the presentation. Josh?
Hi, good morning, not good afternoon. You know, rule number one, if you have a PowerPoint and you're speaking, always print it out the night before, and guess what I forgot to do? He is working feverishly to try to fix the technology, and hopefully there are other PowerPoints by other presenters, and hopefully, you know, through, at some point we'll have that up and running. But here's my PowerPoint. I just scribbled some notes in the back of the paper. First, just a 2-minute description of how the current law works, the Community Reinvestment Act. Banks are required to meet the credit needs in a responsible and safe and sound manner. That's very important. Responsibly and safely and soundly of low and moderate income communities. And federal regulatory agencies examine banks about once every 2 years and actually give banks a grade. And imagine if you were a student and your report card was on the internet. You'd be motivated to work a little harder than if your report card is not on the internet. So it's this system of public accountability that has leveraged a tremendous amount of lending and investing in communities. And there's also publicly available data that you see on the CRA exam, data on home lending. You can get data on home lending by race, by gender, by income of the borrower, and the neighborhood in which the loan is made. And there's also data on small business lending. Anybody from the general public can comment to a federal examiner as the CRA exam is going on, and anybody can comment when banks want to merge. They have to submit an application to a federal regulatory agency to get permission to merge. And sometimes there is a serious issue with the CRA performance of a bank, and people's comments, whether it's an individual, a community organization, elected officials, people's comments to the regulatory agencies have influenced the outcomes of bank mergers, where banks occasionally have to make promises, specific promises, to improve their lending, investing program, or to make sure that their lending is not abusive or predatory. And the public accountability has been very instrumental in leveraging tremendous amounts of lending in communities. Over the last 12 years, for example, we have seen $500 billion, $500 billion of small business lending in low and moderate income communities. We have also seen about $500 billion in community development loans in low and moderate income communities. So you just put those two lending types together, that's $1 trillion in 12 years. And in fact, over the 30-year time period of CRA, we have probably seen upwards of $6 trillion in loans and investments for low and moderate income communities. Now imagine if we take CRA and we expand it to other parts of the financial industry. The $6 trillion we've seen in the last 30 years could be more than double that or even triple that. And in fact, the CRA Modernization Act of 2009, H.R. 1479, does precisely that. The bill was introduced by Representative Eddie Bernice Johnson, and the chief co-sponsor is Representative Luis Gutierrez of the House Financial Services Committee. The bill now has 30 other co-sponsors, and we hope that we get a lot more co-sponsors in the days to come. And one thing that the H.R. 1479 is applies CRA to other parts of the financial industry. Applies the CRA requirements to insurance companies, to securities firms, to large mainstream credit unions, to independent mortgage companies. Independent mortgage companies were a source of a lot of the abusive lending. Now imagine if they had an obligation to lend in a safe and sound manner. If they had had this obligation in the last 5 or 6 years, perhaps, very possibly, we would not have had this crisis. All affiliates of bank holding companies would have a CRA obligation. Now imagine insurance companies, Nationwide, Allstate, if they had an obligation to make policies available in low and moderate income communities and minority communities, we'd have more access to home ownership. If securities firms had obligations to make investments in economic development or small business activities in low and moderate income communities, investing safely and soundly, I don't think we would have seen as much casino gambling on Wall Street the last few years. And again, we may have not seen the crisis of this magnitude, and we may have seen a lot more healthy investments and revitalization in our neighborhoods. And the other thing that CRA modernization does that is very important, as well as applying CRA obligations to non-bank financial institutions, is the bill strengthens CRA as applied to banks. One very important thing, the CRA was passed in 1977. And in 1977, banks made loans through their branches. Now, banks don't make loans through their branches, but we all know that banks make loans through brokers, through correspondence, and through the internet, and through other non-branch mechanisms. So, right now, CRA exams primarily examine banks in the geographical areas that have their branches. But doesn't it make sense to have CRA exams examine geographical areas wherever a bank is lending? And in many cases, we have CRA exams only examining the minority of a bank's loans. That just doesn't make any sense in this day and age. So expand the coverage of CRA so that the great majority of bank loans are scrutinized by CRA exams. Banks have affiliates, mortgage companies. Right now, it is optional for the bank whether the mortgage company is going to be on the bank's CRA exam. Make this a requirement. It's only common sense if that mortgage companies and other affiliates of banks are on CRA exams, that the mortgage companies and other affiliates of banks will work harder to make safe and sound and responsible loans in communities. Now, this subprime crisis, this abusive lending crisis, ladies and gentlemen, started in communities of color. And if we had stronger enforcement and regulation against abusive lending and some prominent discrimination lawsuits early on, like five or 6 years ago, this crisis may have been nipped in the bud. But we know that enforcement was severely lagging. This crisis may have been nipped in the bud and may not have spread to other communities. But we know that enforcement was lagging. But what's very important is CRA looks at lending, investing, and service in low and moderate income communities, and it does not look at lending, investing, and service in minority communities. And there's countless studies done by NCRC and others that have shown that minority communities have been disproportionately affected by irresponsible, abusive lending and by foreclosures. So we must expand CRA scrutiny to lending in minority communities, and that's what H.R. 1479 does. The last thing I'll talk about, and also the bill ramps up penalties against predatory lending, or if a bank purchases abusive loans from another financial institution. It ramps up the penalties for abusive behavior and discriminatory behavior. The last thing I'll talk about is data disclosure. The bill is very important in increasing transparency in the marketplace. John Taylor, President and CEO of NCRC, says that data drives the movement for economic justice. And what that means is if you had data on whether a bank's making loans to women or minorities or low and moderate income people, then you know whether the bank is doing as well as its peers or not doing as well as its peers. It's a very simple and powerful concept. Right now, the small business loan data, you know the neighborhood that the small business is in that receives a loan, but you don't know the race and gender of the small business owner. And just like the home loan data was tremendous in public accountability and increasing responsible lending to minorities and low and moderate income people, if we had the race and gender of the small businesses, we also would see a tremendous increase in lending to minority and women-owned small businesses. The few studies that have been done by the Federal Reserve Board on this topic basically says there is discrimination against women and minority-owned small businesses, which we need to eliminate through more transparency and data disclosure. The HMDA data in this bill would have, right now you know the loan was made, but you don't know the loan terms and conditions. And all these crazy loans that were making loans with debt-to-income ratios above 50% that people could not afford, a high loan-to-value ratio lending, you would have that information about loan terms and conditions if H.R. 1479 became law. So if you had more information on loan terms and conditions in HMDA data the last 5 or 6 years, it is our hypothesis that again this crisis would not be of this magnitude because people could see, there would have been a debate in the general public and the media about all this crazy lending, and I think it would have been clamped down much earlier in the process. And there would be more data on branching and deposits by neighborhood under H.R. 1479. We know that a lot of our communities have been victimized by abusive payday lending and other fringe lending. Let's encourage banks to make more branches and deposit accounts available in the neighborhood by enhancing that type of data and including that review on CRA exams. The last thing I'll say about this is that we all talk about the $700 billion that financial institutions have received in the form of TARP, or the bailout money. What people don't know is that's only the tip of the iceberg. There has been $12.8 trillion in federal subsidies, loans, and investments for the financial industry, not just banks, but insurance companies, securities firms, mortgage companies, any broad type of financial industry. So if the financial sector basically has a federal safety net, shouldn't they have an obligation to reinvest in communities? And if they had this obligation to reinvest in communities safely and soundly, we submit to you that there would not have been a crisis of this magnitude. And we ask you to ask your member of Congress to co-sponsor H.R. 1479, which could be one of the most important laws in leveraging trillions of dollars in additional loans and investments to communities over the next several years. Thank you.
So, did Josh need a PowerPoint? Good job.
I would like to take this time. Josh is really the brains behind this bill. If it wasn't for him, I wouldn't know half the stuff that I know about CRA. Next, we're going to hear from the National Council of La Raza, Ms. Zapate.
Hey, I didn't know it was going to be filmed, but I'm going to try not to be nervous here. I'm Graciela Ponte with National Council of La Raza. It is the largest national Hispanic civil rights organization. We have 300 affiliated community-based organizations around the country. So just to give you a little bit of background on me, I actually was, previous to coming to NCLR, a housing counselor in Prince George's County, Maryland. So doing, helping folks learn how to buy a house, learning the process, the whole home buying process. So it's really exciting. We used a lot of the CRA products. So what I wanted to do today was just kind of give you an idea of how those programs work on the ground. National Council of La Raza is a HUD intermediary, so we've got 50 housing counseling groups nationwide, 51 in over 24 states. So we've been a HUD intermediary for the past 10 years. We help about 40,000 Latino families, Latino and minority families every year, and we've helped over 25,000 of those families become homeowners. Just to start with, I want to talk to you a little bit about the barriers of home ownership for Latinos, which is sort of special. In Latino communities, when they come to you and they're like, hey, I want to learn how to buy a house, and you pull their credit report, many times there's nothing on their credit report. And that's not to say that they're not paying their bills on time and not paying their rent on time. It's just to say that they've paid everything in cash. They don't have a credit card. So when you start off trying to help these families, the first thing you do is say, hey, we've got to help you build a credit history. And they're like, oh, I want to pay everything in cash. And I'm like, that's awesome, but I wish I could do that. But so that's one of the barriers, because when you're trying to look for a house, the first thing they look for is your credit score. There's a lot of great programs that are incentivized by CRA which count non-traditional credit. So you can use your rental income, you can use your utility bills, you can use your car insurance, and they build a non-traditional credit report for you. And those are the programs that we help, that we match our clients with. So I just want to tell you a little bit about two of the programs that we work with. One of them is with Bank of America. It's called the Community Commitment Program. And that when we ask our housing counselors, and when I go back and think about the programs that were accessible to the Latino community, that was one of the best ones. And what it did is you had to take a housing counseling session, which, by the way, is like an 8-hour home buying class. And people are like, oh my God, I have to sit here for 8 hours and learn about the home buying process. But they get really engaged in it. They learn about all the documents that they should read. You know, what is a good faith estimate? What does that include? What is the truth in lending statement? How do I know what my interest rate is? Is it fixed? Is it adjustable? So it's an 8-hour course. Once they get that certificate, then they qualify for, let's say, the B of A community commitment program. So that one, for example, gave them a little lower interest rate than what the market was. They, at one point it was 0 down payment, which was awesome, and they had to pay no private mortgage insurance. And what private mortgage insurance does is it helps the bank. If you go into foreclosure, it's an insurance for the bank, not so much for you. But the Bank of America put that saves you like $100 or $300 a month, which is amazing. But the key is that you have to take the housing counseling course. And so that, because it's less likely that you're going to foreclose if you've prepared yourself. So, so that was one of the programs that really helped our families, where you could count non-traditional credit. We had another program with Citibank that gave folks like $5,000 for down payment assistance. And it was awesome. And as I'm teaching the classes, I'm telling them about these programs, and they're like, oh, well, they don't tell me this at Citibank. And I'm like, of course, because everyone would jump on that. But they tell the housing counselors, they connect them to that. And before I told them that it was a CRA product, I was like, look, I have these 2 products, and you're going to try to figure out which one is best for you. And I asked them, I said, why do you think the bank is doing that for you? And they were like, oh, I don't know, because they're nice. And I was like, yeah. I was like, because they have to, and it's because of CRA that we have those products available to our community. CRA also helped give grant funding that the housing counseling agencies need. And so that's what I wanted to kind of give you guys a little perspective about how our families were able to use these programs. I guess the last thing I want to talk to you about is just, I guess, the need for CRA at this moment, now that we're seeing that the availability of credit is, it's not widely available because of the crisis, the economic crisis and everything. So our families need this more than ever now, because that community commitment program that allowed so many of our families to get home ownership, it's not the same anymore. At this point, it's 8% down payment. It's a little bit higher interest rate. Everyone is really scared to lend to families, and so it's just the availability of credit is not out there. So we do need CRA to help our families connect to good products. And so I would be happy to take any questions later. Thank you.
Next, we have Katie Taylor from the National Urban League. It's a little tight back here.
And I'm very high. Raise this up a little bit. Good morning, everyone. My name is Katie Taylor, and I am the Director of Housing and Financial Education Programs of the National Urban League, which, as many of you know, is the oldest civil rights and advocacy organization for African Americans in the country, entering our centennial year in a matter of months, and 2010. And we serve we have 100 affiliates across the country, small, medium, and large-sized urban areas, serving roughly about 2 million people a year. And while it's a broad service organization, a large measure of what we do is also community building. And our focus is, in this case, on housing counseling, asset building, and community preservation and enhancement. And as you can imagine, I think some of you know some of your history of community development over the years. The reason that CRA came into the fore in the first place was because in the massive disinvestment of the 70s. And that was decimated all the urban communities, but especially decimated LMI communities, and especially communities of color. And what that meant was that not only was there massive waves of arson and actual loss of properties, but actual loss of homes that were owned by minority homeowners before that. So there was a big loss of minority homeownership, but there was also still a vast gap in any lending at all to minority communities. That's to families and to the communities they live in. And because it was created because of the act of redlining, which has long since been proved, of actual racial disparity in lending, and in actual circulating neighborhoods, actual discrimination by geography and race. And so the significance of CRA is not only borne out in how effective it's been, but in how critical it was to set up in the first place. It only proves, just helps to make our case for how essential it is to modernize it for the current times, because what's happened is that lending has adapted, and the legislation and our protections have not. And we've all learned this the hard way. And I'm going to, get into that in a minute. But what I first want to talk about is what it did, what CRA has done for our communities, has done for the African American and minority communities. And you have some excellent, in your toolkit, you have some terrific data, and I really encourage you to read that. There's plenty more than I can say today, of course. But just for example, the wave of community development, lending and investment in communities just in the 90s, where things really started to kick in, and banks and the institutions that were covered by CRA started realizing just how profitable this whole area of work would be. I think before that they were so afraid, I think, of a lot of the impacts of the 70s reverberated through the 80s when there was sudden massive funds available, but they were still a little shy on taking risks. And so the risk model was also based on race. In large measure, as well as just perceptions and some data. Now, with the HMDA data helped to bring a lot of real data into the marketplace for all of us to really understand what's really being loaned. So we started to really see what the disparities, what was going on, and where was the bread and butter actually happening, and what was still happening. But so just from 93 to 2002, home lendings, for example, to African Americans went up 80% in a decade, 80%. So that's almost doubling, which is huge. 90% to LMI communities, and as you know, minority communities, LMI communities are often crossed, right? Often the same. So in places like South Providence, South Chicago, South, all the communities just like Southside that are all over the country. If it were not for CRA lending, these communities would not have been built. We literally rebuilt communities, significant, hundreds of thousands of new homeowners, new homes and new homeowners renovated and created in affordable, stable homes that we actually built communities with. We did a lot of community building from the, essentially throughout the 70s, 80s, and 90s, and certainly into the millennium, only to see it really start to get decimated because not enough, as we talked about before, not enough of the institutions were covered by CRA or any other effective regulation. So there wasn't transparency, there wasn't, there wasn't the actual level of investment that there certainly has been by those who are non-covered institutions who are massively taking hold of the loopholes throughout all the various systems and lack of regulation to be able to exploit a whole lot of vulnerable homeowners with a lot of big lack of information and resources at their disposal to sort good from bad and to sort good opportunities for themselves and their communities from bad. And a big measure of how we ended up in the situation that we're in. One of the big things that we do is we're an intermediary as well, and we have a large housing counseling network of over about 45, 50 organizations of our affiliates, so almost half of our network right now, and that's both on the pre-purchase and the foreclosure prevention side. Foreclosure prevention side, of course, has increased massively since 2006. In fact, we were in the forefront creating a national program, a national focus on foreclosure prevention before anybody wanted to pay any attention to it, much as in NCRC and others. We have been talking about this for Blue Street for a long time, until all of a sudden it's an ocean wave. But the key thing here is that we came out, for instance, with another thing that wasn't so popular yet, and which we hope we're still trying to get traction, and you have here in the back of the room outside, is our Homebuyer Bill of Rights. Where we felt we used this opportunity to put it to the front to help everyone really understand that we do have rights. That just because one lacks proper information or resources doesn't mean they actually are free rein for exploitation. And that is, an essential piece of all of our rights as humans, and in the modern world that we live in. So the only other thing, obviously, the key thing about CRA is that it truly does create safe, sound, and profitable loans, profitable community building opportunities. And the modernization is key because most of that lending is done by mortgage companies, by non-bank and depository institutions. like Countrywide and others, who the vast number of mortgage loans, especially minorities, because there were no branches. More often than not, until the 90s, there weren't branches in a lot of communities. And still in the millennium, still not branches in a lot of communities. That means no prime lending. That means also that they're not, the way they're looking at those clients are not, even those who qualify for prime loans, we're being steered to subprime loans. I think you know a lot of that data, you've all seen a lot of that in the news, we know a lot of how we got into this situation, but it is very much tied to CRA. And we need to close those loopholes. We need more data, we need the other institutions covered, we need the transparency. We also need, the beauty of this is the other services that are covered. The banks, the savings accounts, the branches, the other CDs and investment opportunities to help really communities build assets. We're trying to build it back. Now we have everything we've built for 20, 30 years, the community development movement, we have lost in almost a heartbeat. And that is something we need to take very, very seriously, or we won't have our communities anymore. It's not like the levies that dropped in New Orleans, but it's essentially a financial levy that has broken on us. And we need to be very mindful of all the ways we build it back. And one big way we do that is through CRA modernization. So I think I've exceeded my 5 minutes, but thank you very much, and look forward to questions if you have any later. Thank you.
Thank you. Our next speaker is Corey Carlisle. He's from the Low Income Investment Fund.
I could probably talk loud enough that they can go back there, but since we're all lucky. There we go. Little musical chairs. Good morning, everybody. Everyone's doing all right. I know we're running short on time, so I'll try to be as quick as possible. And I want to thank the members of Congress, Chris, your boss, in particular, for sponsoring today's event. I want to thank obviously my fellow panelists for enlightening us here today, and I really particularly want to thank NCRC for keeping the focus on CRA modernization reform. It's a really important topic for us in particular, and everyone here at the table, and really appreciate them sponsoring this event today. I am the Director of Policy for the Low Income Investment Fund. We're a very large CDFI based out in California with offices in New York, Los Angeles, and here in Washington, D.C. I'll get to what CDFIs are in a second. But today, I guess I'm billed on this panel today to talk about non-single family investments. So much of this CRA debate has been about mortgage lending, foreclosure, and those are very important topics. But there's really two reasons why I wanted to talk about non-single family investments today that are CRA related. And one is my organization is not in the single family side. We have no programs in those areas in particular. But also I feel like that side of the debate doesn't often get talked about nearly enough in these conversations. So they asked me today to come here and talk about a couple examples of very successful investments in distressed communities that directly are a benefit of the CRA. So that's why I'm here today. The Low Income Investment Fund, as I mentioned, based out in California, we are an organization with a primary mission around poverty alleviation. We really are out there working in the most distressed communities across the country. Since we were founded in 1984, we've invested in approximately about $750 million investments across the country, primarily in housing. We used to actually be called the Low Income Housing Fund, but since that time we've evolved and we've expanded to child care and other community revitalization programs, and in particular education is big for us as well. I mentioned that we serve the hardest to reach populations. Most of our, about 71% of our investments go to projects that are defined as very low income, again, which sort of distinguish us, LIIF from other types of CDFIs. So community development financial institutions, often say CDFI. They've really been around since the 70s and 80s. I like to talk about CDFIs as really non-governmental organizations, or sometimes I call ourselves public benefit lenders or investors. We provide affordable banking services to individuals and communities We provide services that usually in turn help stabilize communities and alleviate poverty, obviously, which fits into our mission. CDFIs strive to be profitable and sustainable, but we're not profit maximizing, I guess is the best way to describe the CDFI industry. And so, in your handouts, which I think is on the disc, there's a really great article in there talking a little bit about CDFIs written by Ellen Seidman, who's the director of the Office of Threat Prevention. She talks about CDFIs and their involvement with CRA and how important that is, and also has some great recommendations, all of which have been already echoed by my fellow panelists here today. So, unfortunately, we still don't have projectors, so I'm just going to talk about a couple of investments that we made to give you an example. One, LIIF recently invested $3.5 million for the construction of Democracy Prep Charter School, which is a high-performing charter school serving 300 kids in Harlem, New York. Democracy Prep draws children from one of the lowest performing school districts in the city. Only 48% of the students district-wide graduate from high school, and a grim 1% of those students attend college. Despite this low academic performance of the area, Democracy Prep is remarkable. It really is. It's if any of you are operating in the New York area, I'd love to could show you a site visit. It's really an amazing story. On average, students make more than 3.5 grade level growth in their first year of attending the school. And through the safe and structured supportive school environment and excellent teaching, Democracy Prep has really been an education model that works and paving the way for low-income students to go to college and ranking Democracy Prep among the 1% of New York schools today. It's important to remember that investment would not have happened without CRA. It was schools are typically a very difficult investment for the private market. They're risky. Charter schools, for those of you who know much about the issues they face, often don't have access to typical financing that public schools have. And we've had a lot of great success in that arena, and CRA has directly contributed towards that success. So again, due to that investment alone, there's 300 low-income students that are now receiving high-quality education in New York. The other investment I wanted to highlight today, again, there were, if you can imagine, as you will, some great, wonderful photos that I had. We did an investment in Oakland, California. I chose it because I know Congressman Lee perhaps would be here, or some of her staff, but I thought it was also just an excellent example of a multifamily investment. We put in just shy of $2 million for the pre-development loan that we worked with a community developer to develop the Brookfield Place Apartments in a very highly distressed area of East Oakland, California. Perhaps Adam knows the neighborhood. That's his organization is based right around the corner. Our acquisition loan will enable the developer there to acquire and rehabilitate the property to create 57 units of affordable housing. And those households are at 30 to 60% of the area median income. And those of you who know California knows how difficult it is to do affordable housing in those communities when housing costs are just skyrocketing, even in this downturn. So the housing complex is going to have a community room with a kitchenette, lounge, community service room, a top lot. I'm not sure why people put that in there, but it sounds really cool. And parking, which of course you need in California. There's a services coordinator there that will provide classes such as English as a second language and computer training for the residents there. In total, the project is estimated to save low-income tenants over $19,000 a month in total. Again, pretty amazing project that would not have happened if not for CRA, which incentivized capital to go to this area. And so we're really proud of that project, and it's going to be opening this year. So again, if you're out in California, I'm happy to walk you through that project and see the wonderful families that have been helped out. That's really the only two things I want to talk about. Again, imagine, if you will, some wonderful slides that I had of those projects and smiling people that were there. But really, again, I can't stress enough, I think Katie artfully mentioned that our communities are really in distress. This is a really difficult time. CRA, when it was enacted in 1977, was designed to, again, incentivize investment in these types of projects. But the folks that are covered by this law, the financial community has changed and evolved over time, and we really need to modernize this act. Really, the folks that are covered by this, and they're very proud of these investments, the folks that provide CDFIs with money, the big lenders that you all know well as household names in the financial services community, they're very proud of these investments. This is something that lenders take great pride in what they're doing. And so I don't want it to sound like that it's sort of advocates versus lenders. The lenders doing this work are very proud of it. They're profitable. These investments all pay back. Our delinquency rates, again, probably contributes to the reason why this is not so controversial, this portion of the CRA debate. They perform very well. Our delinquencies are, very, very low in comparison to subprime lending and that kind of thing. So I just wanted to stress those points and reiterate, again, what some of the panelists have mentioned today.
Our last speaker, but not least, is Adam Barones from the Green Lining Institute.
Good morning, everybody.
Good morning.
Everyone excited to hear about small business transparency?
Yes.
Right, that's what I like to hear. Well, my name is Adam Briones. I'm the legislative coordinator for the Green Lining Institute. We are a multi-ethnic, multi-issue organization based in Berkeley, California. We have a multi-ethnic coalition in California of about 40 organizations, and we focus mostly on economic development as well as access to capital for minority, low-income, and other underserved communities. Like everyone's mentioned, I wish my PowerPoint was up because it's honestly the best one I've ever done. I had some great animations. I'll wing it this time. Yeah. So first, let me give you some background on women and minority-owned small businesses and why HR 1479 is going to be so important for them. Right now, there's no transparency in small business lending as opposed to home mortgages or government-backed small lending. There's no collection of this data by race or gender. For small or minority, or for women or minority-owned small businesses. And like I mentioned, let me give you some background. There are approximately 13 million of these businesses. They create about 16 million jobs every year, or they have created 16 million jobs. They have about $1.6 trillion in sales, and they outpace the growth of all other businesses in the business community. And actually, once you dial that down, women-owned minority businesses are doing much better than everyone else. When you consider that by 2050, the United States will be a minority-majority country, this is a very important fact. Also, small businesses, more broadly speaking, create about 50% of the jobs in the United States, and in low-income communities, they create about 80% of the jobs. So they're very important to our community. They're an economic driver, and they're actually one of the few ways that we can create wealth in really distressed communities. So let me ask you all a question. So CRA has a grading system, and the top grade, the A+, is an outstanding grade. So if I was a bank, say Bank of America, I think they're still around, if I wanted to get an outstanding grade in my Community Reinvestment Act obligations, how many loans do you think I should make to a woman or a minority-owned business? How many would I need to make? Since we're short on time, I'll just tell you, 0. You don't have to make any loans. So Bank of America or any large bank can make no loans to a business owned by a woman, to a business owned by an African American, a Latino, an Asian American, Native American, you name it. So while these businesses are a crucial part of our community, integral to our growth, they are not considered under the Community Reinvestment Act. So even though they're not considered, are they being served appropriately by the banks? Do they even need to be considered? The answer to that is we don't really know. Because of Regulation B, Federal Reserve Regulation B, banks are not allowed to collect data on the basis of race, ethnicity, or gender. So really, we're left sort of with anecdotal evidence and studies that try to get the data, but I think don't do as good of a job as programs like the Home Mortgage Disclosure Act, HMDA. One of the few studies that is out there is done by the Minority Business Development Agency. And in their 2008 study, they found that minority businesses accessed low-cost bank loans at approximately half the rate as non-minority small businesses. And the reason this is important is that when small businesses don't use these low-cost bank loans, they end up using things like home equity credit or credit cards, two things that really are a disaster for small businesses. But like I said, these types of studies aren't as good. Their data isn't as good. What they do is they talk to the borrower as opposed to the lender. So they're working off memory. You don't get as good of data. So really, the picture that you get, I think, lays a decent foundation. It gives you a few good talking points, but it really doesn't get to the heart of the matter in the way that HMDA does or the way that the data you get from SBA lending does. So how would HR 1479 fix this? First, it would make small business lending for banks consistent with HMDA and SBA, which collect gender, race, ethnicity data for small business lending as well as mortgage lending. And that's government-backed small business loans. It would also actually make them better. So beyond race and gender, it would also look at the census tract of the business, the approval or denial rate, the size of the business, as well as the loan type and the purpose. And so, as Josh mentioned, what good does transparency do? Is it useful if all you're getting is this data? And, sorry, I spoke out of turn, but as Josh mentioned, HMDA has proven to be an amazingly successful program. Just through transparency, not by setting quotas, not by telling banks they have to lend to a certain group, they've managed to increase home lending exponentially from very, very low levels and show banks that communities that they thought were risky because of their race and because of their perceived economic situation are actually a great investment when they're given safe and sound products. Also, this type of transparency would discourage discrimination. I don't think anyone here thinks that banks are actively discriminating against minority borrowers on purpose, but I think this being the country that we live in, it probably happens. So whenever people know that they're being watched, that these numbers are going to come out, I think it gives people pause before they were to steer, if they were to steer someone towards a bad loan or a loan that isn't good for them based on their race. But most importantly, and this is I think where green lending has a unique perspective, it creates a win-win situation with banks. Right now, because banks can't collect any data on race or ethnicity or gender, they really have no idea if they create a program that's tailored to women, tailored to minorities, say tailored to Latinos in Oakland, where I'm from, or African Americans in Los Angeles. They have no idea if those programs are working because they can't collect that data. So it really gives banks a great opportunity to serve underserved communities, small businesses, with safe, sound, and appropriate loans and make money, because that's what we want. They provide loans to our community that help our small businesses succeed, create economic growth in our community. So it's really a win-win situation for everyone. And I'll close by saying that one of the great things about CRA, and this component of CRA in particular, is that it really shows that minorities, women, and other underserved communities are not a social problem to be solved by social programs. We're an untapped market that, when served properly, when served safely and soundly, which is at the core of CRA, we create economic growth, and that's, I think, good for everybody. So, as our founder, John Gamboa, said before he retired, sunshine, transparency shouldn't scare anyone. The only people that should be scared of sunshine are vampires and people with something to hide. And I don't think banks, as bad as they've been lately, I don't think they're vampires, and they can do a very good job when they're just given the right incentive. Thank you.
Just wanted to drive this home. It is HR 1479. If you look in the back of your toolkit, you can see there's a full page of people, organizations that have endorsed this bill, and right in the last page is the national organization. All these organizations have supported it. NAACP has, the Push Coalition. So you're not alone. If we haven't convinced you yet to be a co-sponsor of this bill, you can contact my office. It's Chris Crow with Eddie Bernice Johnson. So just one last drive it home, last day to come and close this out. Again, thank you all for coming. Thank you.
Thanks, Chris. You know, you've heard about all the good reasons why CRA modernization is needed. So there are other folks walking the halls of Congress, and we know they're reacting to this legislation. So why don't we address what they're saying, why this bill should not move forward. One, it's unduly burdensome to the financial institutions, both those who are currently covered as well as those who the law proposes to reach. Well, let's talk about the dirty little secret. Frankly, a majority of these institutions already have the data in-house. They are tracking loans to African Americans, Latinos, women, and businesses and others. They're already doing it. And frankly, they're a little bit afraid of what may come out if there is sunshine with regard to some of these issues. As was pointed out, with regard to small business lending to African Americans, Latinos, and women, consumers are being steered to high-cost credit cards. It is shameful, 18 to 27% interest rates, when consumers who have business plans that are strong, solid, should be receiving quality loans so they're not forced into plastic or to apply against home equity, if they can in this market, in their homes. Let's also talk about the type of institutions. Redlining by insurance companies has been challenged again and again and again over the past 15 years, even though the civil rights laws were enacted in the 1960s. These are not dated issues. These are real issues. And the secret issue is the cost of those insurance policies and the cancellation of those insurance policies in low to moderate income communities and communities of color. This legislation is very, very important. Last, there are some legitimate concerns about uneven regulatory review, audits, and compliance with regard to CRA. And we believe that, in fact, by applying the same standards and expectations across the financial marketplace, that will give, in fact, every regulator one standard to follow. Regardless of institution, a mortgage company, an investment banker, a large national credit union, those standards will be a bright line to ensure responsible lending to consumers and communities nationwide and help lead this economy out of the mess that we are currently in. Again, leading to a financially inclusive society. Thank you.
Thanks, everyone.
Any questions?